Hi, this is Scott Bruce from Integrity Wealth Consulting with our Educational Economic Update for August 2016. In this month's video, we'll talk about some of the events that influenced markets in July and give you some insight into what they could mean for you as an investor. Please stay tuned at the end for our required disclosure statement. The markets had a lot to think about in July. A British exit, interest rates, and earnings seasons all affected market movements last month. After dropping sharply at the end of June following Britain's vote to leave the European Union, markets regained steam and rallied for 4 straight weeks, pushing the S&P 500 and Dow to new records. We often talk about the importance of not overreacting to market declines. This is the reason why. We cannot predict how markets will perform after a shock, but the biggest market days often come shortly after a pullback. Calmly assessing the situation and avoiding emotional responses is a smart strategy for long-term investors. Okay, let's talk about some of last month's economic events. The Federal Reserve held another open market committee meeting at the end of July and voted to keep rates steady. The Fed's decision was not surprising, and now the debate is on over whether or not central bankers will raise rates at all this year. Investors were surprised at the end of the month by a low first estimate of second quarter economic growth. The official measure of second quarter gross domestic product showed that the economy grew just 1.2% over the previous 12 months after growing 1.1% in the first quarter. This came as a big shock to economists because they expected to see over 2% growth last quarter. Over the past few years, the economy has set a pattern of slowing down in the first quarter and roaring back in the second. Though we'll see more of official revisions to the GDP estimate, 2 quarters of slow growth is concerning. Looking at the data, we see that a drop in business inventories ate away at growth. However, economists expect that to actually boost economic growth in the rest of the year as businesses would rebuild their stockpiles. Consumer spending was the biggest driver of economic growth last quarter, which is a great sign for the economy. A strong labor market, rising home prices, and wage gains all support additional consumer spending this year. The Federal Reserve took the GDP report in stride, saying they believe near-term risks have diminished. We can take this to mean that they want markets to prepare for a possible rate hike this year or early next. What can investors expect in the coming weeks? In a word, volatility. Overall economic fundamentals in the U.S. are looking solid. However, turmoil overseas, a presidential election, and anticipation of future interest rate hike increases will likely affect market movements. As always, we will keep you informed. I'm Scott Bruce from Integrity Wealth Consulting. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call. We'd be happy to talk to you.